Welcome back to another episode of Retired Right. I am Ron Wyatt, and today I'm joined by the senseis of the stock market, Ron Wyatt and Nick Lewandowski. Gentlemen, how you doing?
Doing very well. Doing great.
Appreciate you joining for another roundtable discussion here today. What I wanted to talk about today is our firm-specific investment approach. I know we have a term for that. It's called all-season framework. And really, how it's structured, some of the risks that it helps minimize, and how it takes guessing or market timing or predicting what's going to perform well and what won't, basically completely out of the equation. Per usual, just going to start pretty high level, and then we'll kind of drill down from there. But first question I have, and feel free whoever wants to chime in, is in your own words, like what is the all-season framework that we use, and how does it work, or what's its intended use?
So the all-season framework, the goal is to generate an attractive return that's as consistent as possible. That's simply the goal.
Okay. And I know the second part of that was how it works. Should I pull up the graph that we use to explain how it works?
Yeah, let me first of all go over a little bit of the history. So since the 80s, during my whole career, the traditional 60% stock, 40% bond allocation worked very well for retirees, for most retirees. And then what happens is we get into COVID, interest rates for the 10-year treasury drop below 1%. Mm-hmm. And so for that balanced portfolio, all of a sudden, 40% of it, or maybe 50% that's in bonds, is basically giving you no return. And for retirees, that's obviously a huge concern. Right. And then the second thing is, and we talked about this in the episode about bonds, is that the interest rate risk, the duration risk of the bonds increased dramatically. And so when this happened, we start coming out of it, we start reinflating, the economy start doing well, inflation was going up, interest rates were going up. I start doing a lot of reading because I knew that we're in a totally different environment than I had been in my whole career. So I took months and read. And that's when I came up with the all-season strategy.
Got it. So it was kind of shifting from using securities that would perform well in an environment that we were in for a long time.
Long period of time.
To not completely abandoning those securities, but adding additional ones into the mix that would do well in the new environment that we were in.
Basically, the new environment we're in, but basically in any environment. I'm trying to, we don't have a crystal ball.
Got it.
So whatever environment we're in, we're trying to get more steady returns.
Okay. Well, I think, so what I should do now is I know because we have a graph and we show our clients this graph. I'll pull that up on the screen now. Can you just explain what we're looking at as we progress through different, economic environments or market environments, how that graph would pertain to transitioning through those environments?
Sure. So what we're doing is we're looking at a bunch of different individual asset classes. Now, this is not an all-inclusive list. Many of these we use. And we're looking to see how they correlate to when the economy is strong or weak, or when inflation's high or low.
Okay. So on the horizontal axis, we have, on the left side, we have low economic growth.
Yes.
On the right side, high economic growth. And then the vertical axis, the bottom half of the graph is low inflation. The top half of the graph is high inflation.
Exactly. So people ask me all the time questions like, with politics, if this person gets elected or the other person, or if a war breaks out, or there's, gas prices go up or down, what does that mean for the stock market or the bond market, right? And so what we're doing is that the outcome of those different things that can happen is that the economy gets stronger or weaker, inflation goes higher or low. That's it. And so that's what this is built. We don't need to know what's going to happen to make a really solid investment plan.
Got it. Okay. So then in practical terms, or like what we're really doing in client portfolios is we are diversifying across, I know there's nothing down in that Goldilocks or that bottom right quadrant. Maybe you can explain why, but what we're really doing is we're diversifying across the assets in the other three quadrants because, like you said earlier, we don't have that crystal ball. We don't know when we're going to be in the expansionary environment or how long we're going to be there. So we don't try to predict that. We just use securities, regardless of the environment that we're in, tend to do well in that environment.
Exactly.
Okay. And why isn't there anything down in the bottom right, the Goldilocks quadrant?
Yeah. So the reality is that everything that does well in the quadrant above it, expansion, will also do very well in Goldilocks.
Got it. Okay.
Goldilocks doesn't happen very often where you have very high economic growth and very low inflation. And if it does happen, it doesn't happen for very long. It doesn't last for very long. It's much more typical for the data to show, high growth and relatively low inflation, modest inflation.
Yeah, the equities like some growth and a little bit of inflation, but not too much.
So the data just shows things in that quadrant because that's where most of the data ends up.
Understood.
Plotting. Yeah.
So are there any additional risks outside of, again, taking that guessing out of the equation or the market timing or the predicting what's going to do well? Are there any other risks that you are minimizing by using this all-season framework?
I think other than taking the prediction out, I think there's a benefit, like Ron was saying, for people to be able to contextualize what's happening in the world and say, this is why I own this in my portfolio. This is how it impacts my portfolio.
And I can give examples. If you look in the bottom left, you see treasuries. Well, when there's a recession, economy slows, inflation tends to go down. That's when you want to own treasuries, like during the global financial crisis. Top left, the economy's weak, inflation's high. You're worried about credit risk, right? So treasuries make sense. But if rates are going up, adjustable rate treasuries make a lot of sense because as rates go up, you get paid more. Top right, private debt. That's debt of non-publicly traded companies. They tend to be adjustable rate. And when inflation is high, maybe moving higher, and the economy's strong, we don't have to worry about credit risk. So we don't have to worry about the credit risk of private debt as much. But as yields go up, they pay you more. And probably at the height, when interest rates were higher, the private debt was probably paying 11, 12%.
Yeah.
So it's a great asset class to have. Those are just examples.
Got it. Yeah, and I know we're throwing around a lot of technical terms here. If you want some additional context behind those terms like credit risk or floating rate or private debt, just watch the episode on bonds that was actually released 2 weeks prior to this episode. That should give you some good background context there. So the next question I have for you guys is it all is this all just good? Or are there any drawbacks to using this all-season framework?
There's pros and cons to every strategy,
okay,
right? And the downside to this one is because you're diversified, you're always going to own something that you would rather not own because it's not going to be the perfect thing for that environment. So when you're in that recession and you are very happy and you want to cozy up to your treasury bonds and just wrap yourself up in a treasury bond blanket because everything else is scary and not doing well, you're going to be like, I just want to dump the stocks. I'm not happy with them. And on the flip side, when the stocks are doing really well and economic growth is high and it's big green numbers every day in the stock market, there's a tendency to look at the bond portion and say, oh, do we really have to own this? I feel like it's not very exciting. I want to make more money. Things are good. So I think the drawback is that you have to balance your emotions in that regard and kind of resist the urge to make huge changes and dump things. Stick with it. Yeah.
That's a tough conversation to have with clients too. Because I think it's inevitable to feel that to a certain extent. Certain securities or asset classes are doing very well. Certain aren't at different times. Maybe you're investing in those ones that aren't doing very well at that point in time, but they serve a purpose in your portfolio. So I guess, how are you guys, if a client comes to you and says, using Nick's terminology, I want to get out or dump this portion of the portfolio and I want to go into what's performing well, kind of chasing those returns. How are you guys advising people when they bring that up to you?
So what we start with is a financial plan.
Okay.
So we can determine the rate of return that we need to achieve someone's goals. We can measure the risk and see if it's appropriate for the client. Basically, can the client sleep at night? That's the ideal plan. There's enough return to achieve goals, they can sleep at night, right? Once you have the plan, studies show that by having this plan and understanding, as I don't know, I forget Ryan or Nick had said it, like, understanding the framework. You don't need to be an expert, just general understanding. It's easier to not panic, to stay, to think long term when you're thinking about the plan and not the daily fluctuations of the market. So that's what our whole process does, the whole financial plan and then the investment plan. Okay.
Yeah.
Now, on the flip side, some people, going back to the crystal ball analogy, some people think that they can predict where the market's going to go. And a lot of times they do that based on a rearview mirror. They look at what's been happening recently and project that's going to continue. Well, it'll continue for a while longer before it reverses course. And oftentimes you end up buying high and selling low. That's not what you want to do. And if someone is looking for someone to time, we are not the firm to work with.
The other piece I'll say to that is, we have an instance specifically in that I want more return impulse. Sometimes people like to buy lottery tickets, right?
Yeah.
It's part of the market. It's part of the game. It's fun, right? And I think we take the approach of it starts with the plan. So if you come to me, Ryan, and you're like, hey, I need to add to my Dogecoin holdings, it's going to the moon, I can feel it. My first step as an advisor is to say, okay, let's pull out your plan. Ryan, what does your probability of success look like? Oh, it looks really good. Oh yeah, I mean, your goals are on track, everything. Then the conversation becomes, all right, how much is reasonable to put into that Dogecoin purchase? And, it might be a couple percent of the portfolio, depending on someone's, if someone really wants to go after it and all that. But the flip side of that is we're going to say, here's what we earmark. Here's like the boundary we're going to put on it. And Ryan, it's up to you to decide when to buy it and when to sell it, because it's not part of our strategy.
And that just means that I have to be right a lot more often if I'm making that many decisions. The timing on when I'm purchasing, the timing on when I'm selling. Typically, when you're doing that, the more often you're doing it, Ron said earlier, you're going to be buying high, selling low. Just doesn't really make sense. Going to diminish your returns. And the other thing too is, Nick, I like the way that you put it, but the way I the importance of a financial plan, or I guess the strength of having a financial plan is you can really model it it shows you your options. So if you want to sell and go to cash and try to time it, well, we can model that into the plan and we can show you if that can be favorable to you or not. If you want to increase your risk and chase these high flying stocks and go from a well-balanced portfolio to a more equity focused portfolio, we can show you that and we can model in, hey, what happens if there's a severe market downturn? Can you still meet your funding goals if you have to sell positions when they're down 20, 30, 40%? So plan just really is a good way for you to actually model out those different options and the impact.
The worst thing to do, I've seen this, some people during the tech bubble get all excited. They want to go from a balanced portfolio to an equity-oriented portfolio, then a tech portfolio. Then all of a sudden, the 2002 bear market hits. They want bonds, and then all of a sudden they're like, "Hey, real estate's great." So they go into real estate, and then that blows up.
Yep.
And they're just chasing what's doing well. They think that they're being proactive, but they're really being reactive and chasing.
Yeah, it's one of the hardest conversations to have because when I've seen before a client when I used to work in Virginia. I think it was during the 07-09 crash, they sold out, they went to cash, or maybe it was even the tech bubble, and they never went back since. And because they've been sitting in CDs or cash-like investments for an extended period of time, they couldn't have a probability of success in the retirement plan. They were going to have to either change how much they wanted to spend, go back to work and work longer. It just wasn't working because they took themselves out of the market and were too afraid to go back in.
So what we do is, so that one approach is the crystal ball approach. We don't use that. The other approach is, have a plan, financial investment plan. And then what we do is something called rebalancing. So think of it this way. Stocks run up a lot, they get more expensive. You're trimming stocks, right? Maybe you're buying bonds or alternative investments. On the other hand, stocks are down a lot. bonds are up, you're trimming the expensive to buy the cheap. That's all you're doing, rebalancing, right? So we look at it in retirement. You only want to have one retirement, right? You don't want to have to go back to work or be forced to go back to work. And so the way we do it is the least risky. What I mean by that is the least likely way you're going to shoot yourself in the foot.
Mm-hmm. Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Now, let me ask you this here. I just want to wrap up with this question. And Ron, I know you were kind of the primary, let's say, contractor, architect of this all-season framework that we use. But between the three of us, I think we've worked at a lot of different firms in the industry. We've seen a lot of different approaches. Would you say that this framework that we're using, is this widely accepted and widely practiced as like the norm, or is this something that makes us different in a positive way?
It's not widely used. I've never competed against another firm that uses it.
Okay.
And I have a lot of friends in the business. I have never heard them talk about using it. So I don't think it's widely used. Now, it's been academically researched. There are some large institutions like hedge funds, for example, that might be using it. But for the clients that we're working with, retail, clients getting closer to retirement, high net worth, I don't see it being used.
So would you say that there's a reason why? And if the reason's as simple as that, hey, I'm a huge investment nerd, I just love reading about this stuff, and that's the reason why we're using it. Maybe some others aren't, but is there a reason why we're using this and maybe other firms are not?
Well, I think that
yeah, please help me on this one.
So no, I think that some of this, the concept of like the 60-40 balanced portfolio is not unique to us. That's something you'll hear anywhere in the industry. And that does contain part of the intuition of this, which is that you have bonds to offset the stock market risk and balance it out. So that's very common. What I personally think differentiates what we're doing here is we're thinking very explicitly about the stagflation scenario and the use of the floating rate treasuries to balance us there. And also, like Ron sometimes calls the direct lending strategy, the secret sauce in the whole mix. I think the combination of the floating rate treasuries, the direct lending, and literally just mapping out the framework on a regular basis is what we're bringing to the table.
Got it.
Unique.
By mapping it out, we can, we know our risk exposures. I can go and look at historical data for a very long period of time to see in different environments how it would work. And so it makes a lot of sense. And one thing I wanted to mention too is that we've been talking a lot about balanced portfolios, but we do have clients that have, all equity portfolios. And that's quite fine. When you have an all equity portfolio, you're going to be, in stocks. And so you're not going to get as much of a benefit of this framework, but people who have all equity portfolios tend to be thinking long-term and want maximum return. And there's nothing wrong with that. This framework works best for people who are equity-oriented but still balanced or balanced.
Got it. I hope you found this episode informative. If you're listening to us on Spotify or Apple Music, give us a like or a follow, or if it's our YouTube channel, feel free to subscribe to us. We release episodes every 2 weeks. And then if you're interested in furthering this conversation with us or a member of our team, just check out our website. It's wyzewealthadvisors.com. Wyze is spelled W-Y-Z-E. And then all you have to do is look for one of the big green bubbles, click on free Retire Wyze assessment. It's a simple 3-step process that's really crafted for you as a prospective client to evaluate our services or take our services for a test drive. And we can certainly fold in this all-season framework into that conversation. Again, hope you enjoyed. Feel free to share the episode. Thanks.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.